Okay, next we're going to hear from Alfred Griffin, who's the president of the New York Green Bank.
Thank you, Jeff, and let's see if I can find my pages. Well, it's a pleasure to be here, ladies and gentlemen. I am originally from North Carolina, and I went to school here, and I met Jeff when I was at Citi a couple of years ago. Somehow I heard a little bit about what the Environmental Finance Center was doing and had no idea, and started reading some of the research, and it was spot on to a lot of the initiatives we were involved in, so began developing a bit of a relationship. So I'm really delighted to be here today. So I am president of the New York Green Bank, which is a new organization. It was announced by Governor Cuomo in January of 2013 in his State of the State address as a $1 billion initiative to help bridge financing gaps where there are economically viable projects for clean energy deployment that the financial markets are not supporting. And the New York Green Bank is just one part of a very broad energy plan being put forth by Governor Cuomo and the energy team for the state to deploy more clean energy. So as I think Jeff was starting out, and other people have alluded to, one thing about clean energy is that there's typically a large upfront cost, but economic benefits as you go along. So if you think about a solar portfolio or a solar field, it's a big investment up front with very little cost on an ongoing basis. And that really means you need financing, and you need a lot of it. And it needs to be longer-term financing. If the benefits of if a solar field is expected to produce for 30 or 40 years, you probably need 15, 20, 25, 30-year financing. And we're involved in solar, wind, anaerobic digestion, waste to energy, making buildings more energy efficient, really anything that would improve the greenhouse gases in the state of New York. The opportunity is huge. Booz and Company did a study for the state of New York prior to formally launching the Green Bank at the beginning of this year, and estimated that the positive PV clean energy projects in the state of New York alone, the notional value is $85 billion. I think we've all seen studies, federal studies, world studies about the kinds of capital needed for positive PV projects, and it's certainly in the hundreds and hundreds of billions, if not the trillions of dollars. And there's only one place that kind of capital really can come from, and that's the institutional capital markets. That's where that kind of capital can be found, and we think that entities like the New York Green Bank should really be focused on how do we get more of that kind of capital in the marketplace. So why so many undeployed projects? Well, it seems like it's the old chicken and the egg story, where if we were to talk to developers in the marketplace, certainly in New York and at Citi, I had plenty of conversations with national developers, they would say that, they have so many great projects to invest in if they could only find the financing. It's just the issue is the financing's not there. And then if you go talk to the pockets of large capital, whether it's pension funds, other institutional investors, large banks, insurance companies, they say they would love to deploy capital in this sector. There's just not enough supply. There are not enough projects. So that's the quandary we have. And it's not the case for all sectors. In the financing world, if you think about large utility-scale project financings, billions and billions of dollars flow into that sector every year because they're $500 million projects, billion-dollar projects. If they make sense from a financing standpoint, the banks and insurance companies and other investors will figure it out. On the other side of the equation, nationally, very small projects are getting done on the residential rooftop space. So if you think about the solar cities and the Sunruns and the SunPowers of the world that are deploying very user-friendly models where they provide a lease or a PPA structure to a homeowner, they're getting billions of dollars of financing a year. Well, why is that? They have a very standardized methodology for underwriting credit, which is FICO scores for consumers, and very homogeneous contracts. They have the same contract for every homeowner. So a banker just has to look at one set of documents one time, and they don't have to look at a new set of documents for every $25,000 rooftop facility put into place. They can aggregate thousands and thousands and thousands. It's very standardized. But what about all the other sectors? What about energy efficiency, commercial solar, smaller standalone projects? It's sort of like the kid looking at the apple here. You know, an investor, if you're lucky, you can find one investor that's interested in taking a look at what you're describing, and they're kind of scratching their head. They don't quite know what to do with it. It's really complicated. Any project financing where you're financing a project is complicated. You have the risks around, you know, will the project perform? Will the solar panels produce energy? How much will the sun shine? And then you have the question, well, if it does produce, who's the counterparty that's going to buy the power? And project finance teams at big banks are used to saying, oh, well, it's PG&E or it's Con Ed or it's Duke Energy. But much of what we have to do here, those will not be the counterparties with distributed generation. It'll be a building owner, a middle market warehouse company, you know, any number of other counterparty credits folks aren't familiar with. It'll be new servicers, new developers that project finance teams aren't familiar with dealing with. So it's complicated. There's a lot of work to be done. And the financial parties in the sector are capable of figuring that out, but then with the non-utility scale, more the at-location power generation type transactions, they're really small. And you can't, it's tough to ask a banker to put a whole lot of brain damage into a transaction for a relatively small transaction size. And how is that usually overcome in the markets, whether it's, you know, credit card portfolios or auto loans or home loans, or in the example of residential leasing transactions for solar around the solar cities and the sun runs, it's by standardization. And so much of this sector does not have standardization. And then you say, well, a banker can figure out how to standardize a product. They can figure out how to deal with all these credits. They can figure out how to deal with the project risk and will they perform. But they only want to do all that if they think there's real scale there, like substantial volumes that will really make a difference for their institution. And in some of these cases, that hasn't been proven out yet. So the bankers sort of rationally pass and move on to the next transaction where they have less uncertainty in that regard. So that's where we think the Green Bank comes into play, because we are really looking to be involved in only those transactions that we ultimately think that the private sector will step into our shoes. If the private sector is efficiently operating today, we don't need to be there. We're not here to be competing with the private sector or crowding out the private sector. We're here to be crowding in the private sector. So what can we do for those transactions that we think that with greater precedent, more history, and more scale, more visible volumes and scale, that the private sector would step into our shoes? And those are the transactions we want to focus on. And we also need to have a very specific game plan as to what needs to happen. What is the X, Y, and Z that needs to happen such that we feel that 1 year from now, 2 years from now, in this particular sector that we're focusing on, that the private sector will step in and start financing for us. So how do we do that? Well, first of all, the New York Green Bank is not determining what the private sector should focus on. We're very much in an outreach mode to tell the private sector, tell us those transactions that you think are worth your time, that you want to emphasize, where you think there's a real opportunity, but there's a financing gap, and how can we help fill that gap? And we may fill that gap by providing credit enhancement to help make the credit analysis a lower lift, where in some cases there's less precedent history. We could fill that gap in terms of aggregation financing, where there's a particular portfolio that a developer is credible in delivering, and there's a set of investors, say an insurance company, that's interested in owning a portfolio like that, but it needs to be a funded portfolio of a certain size in order to get that investor on board. We can provide that warehouse financing. We also will be promoting standardization in everything we do. We will be looking to use standardized underwriting approaches for particular asset classes, standardized technologies, standardized documentation, etc. And we will be looking to promote the collection of data, because ultimately being able to look at historical performance is the best way to get the private market and the rating agencies. I think somebody from the rating agencies might be here to get the kind of ratings we need to get institutional and capital involved. So that's a quick overview of what we are looking to accomplish, and look forward to questions later. Thanks, Jeff.